Hello and welcome back to another video. In this video, I'm gonna go over 5 stocks that I believe are going to outperform the market in 2026. The 5 stocks that I'm gonna be going over, starting with Adobe, and then we're gonna have Mastercard, MercadoLibre, Meta Platforms, and Uber. So grab a drink, maybe some popcorn, and let's get straight into it. And at the end, I'll go over my DCF calculation for every stock. First, let's start with Adobe. Adobe has been down for 5 years straight. As you can see, it's around negative 29%. In this stock, for 5 years straight, this stock has been underperforming the S&P 500. Now, Adobe has a PE ratio of 21 right now, and the return on invested capital of 22. Now, this is something that I really like. As well, let's look at Adobe's revenue. So Adobe's revenue is 17.34% CAGR, and one of the reasons that Adobe was down all this time is because the fears of AI and AI disrupting the Adobe suite. And if you notice what I said right now is suite. Yes, because Adobe has multiple products. I went deeper on another video that I have in my YouTube channel about how Adobe's products is so deep. When a creator uses them, they don't just buy Adobe for one product. They need all the products. So it makes no sense to switch to another competitor and even use AI, because if you look at Reddit and if you make a post and type, "Are you guys replacing Adobe with AI?" they're gonna laugh at you, because no one is replacing Adobe with AI right now. Adobe gives you the freedom. And at the same time, people are not realizing this, is Adobe also has AI into them. They can generate these images that ChatGPT generates as well. But the good thing about Adobe is that it allows you to have this freedom where you can edit things, you can remove things. When you generate an image with ChatGPT, you're stuck with that image. You can change it. I mean, you have to go back and forth with prompts to change the image. But you know what I mean? You can't just like take a part or add a certain piece of element into the picture. It's just a standard picture. Adobe gives you this type of freedom, and a creator would like this type of freedom. And also some fears from their competitors, okay? And their competitors are not even here. The only competitor is Figma and Canva, but Figma is more on the web development website, and Adobe has totally gave its market share to Figma, because Adobe is not operating in the website segment. It's more in the Photoshop, video editing side, After Effects, all these type of things. And then you have Canva. But of course, as we know, Canva is not made for professionals. Canva is made for people like me and you that want to post for their business, or for on their Instagram story, they want to make a small edit of something. They're not made for professionals that are dealing with millions of projects, worth of projects. So as you also can see, the revenue is still increasing. No revenue. You know, if the revenue had decreased, I would have said, okay, maybe there's a competitor, maybe AI is, but no, the revenue is increasing. And same as well with the gross margins and their operating margins. It hasn't been going down, which tells me that they did not had to give some of their margins to compete. Their margins was their operating margin was 25, now it's 36. Their gross profit margin is 86, and now it's 89. So this does not tell me that they're facing deep competition and they need to decrease their margins. Now, if I also take a look at their net income and free cash flows, I can see that their net income and free cash flows are growing in a steady place, where their net income is 27% CAGR and their free cash flow is at 22% CAGR. So when you see this type of how can I say it, the value of the company is going up, the quality is going up, their fundamentals are going up, but their technical, which is the price, is going down. This is a dislocation, and this is where I love to invest in these companies. I really like to invest in companies where it's quoted as dead. Company is killed by X, and it's a quality company, and it's not killed by X. And we see from the revenues, we see from their financials that they're not suffering for competition or anything else. And then the company is trading at dirt cheap. This is where I love to buy. This is where I get interested. That's why I also hold Adobe. Full disclosure, I also hold Adobe. So I think Adobe in 2026 is going to perform really well. And let's also look at their PE ratio. So their PE ratio is also trading at the lowest PE. I mean, you can say here was the lowest, but you know what I mean. It's trading at the lowest PE. So I really think that the price of Adobe right now is a steal, and that's why I added at this price. I think the company next year is going to perform well. It's going to have this Google run. It might not double, but I think it could. I think it does have the chance to double. None of this is financial advice, and please talk to a financial advisor if you have any questions. Okay, now let's run a DCF calculation for Adobe. I will look at their free cash flow change. You see that their average is 22 and their median is 25% change cash flow growth. I'll put it at 23, and then their ratio is at 32. Now I don't want to say this is gonna happen, so I'm gonna be more conservative, and I'm gonna say we have a growth of 11%, the same as before, and price to free cash flows of 25. You're still getting 26% return. Let's say even 20. You're still getting 20. So let's say even lower. How about that? Even lower. At a 15 price ratio and metric growth of 14%, you're getting 14% CAGR return, which is beating the market. So even being very, very conservative, you're still beating the market. I think Adobe is a great buy to have in your portfolio. Again, not financial advice. The next stock we have is Mastercard. And also, full disclosure, I own Mastercard. Mastercard is a great business because really it acts as a double-edged sword. And what I mean by this is when is there inflation, Mastercard wins, because higher prices means higher revenue for higher fees, therefore higher revenue for Mastercard. And when there's interest rate cuts, it motivates spending, therefore more transactions, more fees for Mastercard. That's why I love this business. I think it's a great company. Let's look at their revenues. The revenue is growing at 12.8%, which is not bad for the size of a company like that, and especially how long it has been in the market. Now, what I love the most is this. This is absolutely insane. A gross profit margin of 100% is insane. Literally did not drop in the last 10 years. And your operating margin is sitting at 52.5%. Now also your free cash flows is growing at 16.2%, which has I love to see this. I love to see a steady growth of free cash flows, steady growth of net income, which we're going to look at here. All steady growth of net income at 14%. But by far my absolutely favorite metric to look at, and even Charlie Munger's absolutely favorite metric, is return on invested capital, which is sitting at 50.4%. This is amazing. I usually like to see this above 10%, and this is 50.4%, so this is even better. Even though it went from 71% to 50%, that's not bad, because at the end of the day, it's still 50%. A lot of the companies don't even have 50%. I mean, let's look at their industry. Let's look at American Express, for example. Their return on invested capital is 13%. Okay, let's look at Visa. Yeah, the return on invested capital is 24%. So 50% for Mastercard. This is good. This is really good. Now let's see what type of returns can we expect in the next 5 years for Mastercard. Now, if we take the average free cash flow growth for Mastercard, which is sitting at 20%, I'll put here 20%. They're also doing share buybacks, which is at 3% negative. Now, as for their ratio, it's sitting at 35, which is their average. Let's put it at 35. You're still getting 26% CAGR return in the next 5 years. Now, let's be more conservative with that. Let's put 15% growth. Okay, actually, let's even be more conservative. Let's put 10% growth, and which is the average last 5 years was 17, by the way. So I'm putting 10, which is super low. And let's keep the price free cash flow at that price, and then you're getting a 15%, return for the next 5 years, which is still beating the market. So even with being too conservative, Mastercard will make you beat the market, which is what we want here, and this is why you're watching this video right now, right? The next stock we have is MercadoLibre. MercadoLibre is basically, if you think about eBay, Amazon, and PayPal, this is what MercadoLibre. It's all this in one, operating in the Latin America, and their main markets are Argentina, Mexico, and Brazil. Their PE ratio is 48%, not percent, it's sitting at 48. I'll go here over their margins and I'll explain what I wanted to say right now. Their margins is, their operating margin is 12% and their gross profit margin is 45%. Now, they don't have high margins like the ones we saw before, because the ones we saw before are fintech or like financial sectors and software sectors. They usually have higher margins. But for this case, when you have something like this, you can't just say they have bad margins. No, you need to look at their industry and you need to look at their competitors and what are their margins. And MercadoLibre is sitting at a healthy margin according to their competitors. They're not super high and they're also not super low. So it's an okay margin. And especially I think in the future it's going to go more up because of their fintech side that's growing. Their free cash flow growth is incredible. It went from 158 million to 8.6 billion. That's crazy in just 10 years. So I don't know if they're gonna be able to maintain this type of growth, that 50% or anything close to that. I mean, it's showing you that it's slowing a bit, which makes sense, but it's still a growing company. It's really becoming the market leader, and especially in Argentina, where it kind of had like a monopoly there. Even though we have other competitors like Amazon that's trying to spend and take market share, MercadoLibre has shown that it's being the staple company for Latin America for the whole e-commerce, and especially because they also have the fintech side, so it makes it more sticky. I know that in Latin America, nearly 50%, not 50%, less than 50% do not have bank accounts. So this makes MercadoLibre's fintech side even more attractive. Their revenue as well grew at a 46% CAGR. I mean, this is also incredible. I really like this company. I do not hold it, but I'm really considering it. I'm really considering it. My only fear was the Latin America economy, but you know, even when I think about that, I also look at the chart, and the economy of Latin America has been struggling for some time now. And even though they have been struggling, they're still growing, which proves that my thinking is wrong, because they're still growing. So yeah, I mean, it's an insane company. It's growing at a fast pace, I should say, not pace. And let's do a DCF calculation and find what can we expect in the next 5 years specifically. Now, I don't even need to look, because if I look, the numbers are high. So I need to be very conservative. Even when I'm being very conservative, the numbers are still insane. I mean, you're still getting 32% CAGR. I mean, I'll put 10. I'll put here 17, 12%. I mean, it's not gonna happen. Their average is 60 for the last 5 years. And their average price ratio is 61. And I'm putting 10 and 17, and you're still getting 12%. So yeah, it's not gonna happen. I think it might be like 25. Yeah, and it might be here like 30. Yeah, not even 30. Like it's actually insane how this company is growing. You need to put like incredibly low metrics and calculations to see what price can you get for the next 5 years and what percentage on return. It's insane. And this is a thing with this type of calculations. I mean, at the end of the day, you're looking at the future, and we don't know the future and how it looks like for them. So I can't put high numbers or too low of numbers, because if I put the numbers they're sitting at right now, like if I put 61 and then I put here 60, it's insane. I don't think they're gonna grow at this growth at all. It's you're not gonna get 100% every year. It's insane. So that's why maybe I'll put it 20, and like even when I put it at 20, I put it 20 and then I'll do this 30. It's even too high. I can't give, actually for this one I can't give any expectations, because any low price or any even high price makes it even more attractive. Like I said, even if I put 10, I'm getting 15. It's insane. I would even if I get 10, I put and get it 15, so I'll take it. I'll take it. I'm still thinking about it. It's in my wait list. Yeah, not wait list, watch list. And yeah, I mean, I might be buying after this video. The next stock we have is Meta Platforms. This is a company I also own. I think Meta is an absolute beast. Meta has 3 billion, around 3.5 billion people on their platforms. And I want to say something. This is the time where companies spend money on their ads. And what better way than spend it on 3.5 billion people, right? Also, I noticed that Meta, their AI model in Instagram is getting better. Their Reels, their algorithm is getting better than TikTok. I actually use Reels more than TikTok right now. And one thing you would notice is sometimes when you have a translated video, it really translates so well. And at the same time, you're also seeing more ads on Meta, but they're not those annoying ads that sometimes you get on YouTube, right? Sometimes in YouTube, you just get like annoying ads. In Meta, when you on Instagram, you don't get these annoying ads. It's actually most of the ads that I get are ads that I would be interesting. So I think they're like spying on your messages and trying to target you as for ads. So yeah, their return on invested capital is 29%. That's something that I love to see. It's higher than 10. Also, their revenues has been growing 27%. Really looks nice to me. And then also their operating margin and their gross margin, it's not bad. It's pretty high. It's pretty high for Meta. Gross profit margin is at 82% and operating margin is at 43%. You also need to know something about Meta, is that they have their glasses, and I really believe that Meta is going to make a device, either glasses or not, which is going to be your third essential device. The Meta display glasses, I mean, I wish I can have them, but they're sold out. They were sold out the moment they dropped. Everyone wants them. Not one person was like, oh, I'm gonna return it. I don't think I need it. But no, it's the amazing technology that they want to have. Their glasses segment and their hardware products, I believe that they're gonna be a decent segment of revenue for Meta in the future. I think it's only gonna grow from here. I mean, it's going to be interesting to see how this might drop their margins a bit, because now they're selling hardware. But I don't see that happening really that much. Their free cash flow is an average of 19% CAGR, which is not bad. I like to see up and to the right, and this is what I see, even though sometimes it goes down. But at the end of the day, it's still up to the right. Now let's do a calculation and see the expected returns that you can have in the next 5 years with Meta. Their average is 34 to 40. So even being very conservative, I'm gonna put 25, and then their average ratio here is 27. So I'll keep it at 27. You're gonna be expecting about 19% return every year for the next 5 years. Even if I want to be more conservative, and I'll drop the prices a bit, you're getting 12% beating the market, but I don't think it's gonna be that low at all. I actually think it's gonna be higher. Like I said, I think it's gonna be around 27 to be conservative, 25. So I see more growth for Meta than a decline. I think the price is sitting actually at a good price right now. It's trading at a good price, where if you buy right now, you might get a nice return. Again, not financial advice. Nothing is financial advice. Please do your own research and contact a financial advisor if you need advice. Now, the final stock that we have is Uber. Uber has been trading nicely this year. Let's look at it. It went from $64 or 61 to the hundreds. It broke 100. I don't know why this chart is not showing it, but it broke 100. And then it dropped back. And the reason it dropped back is fear from autonomous vehicles, Waymo, robotaxi. I'm a investor of Uber. I think they're gonna have a great upcoming years for them. Maybe not next year, but I think it's gonna be next year. But maybe not next year. The one after. But I think they're gonna be still winning. Uber Eats is growing at a fast pace. Also, you need to understand with Uber, it's not just a rideshare company. It's basically from A to Z company. Really, it's like the whole delivery, not just delivering people, not just delivering food, but even like they launched their Uber Ski, a full ski trip planned for you with Uber, and you have Uber rides planned for you and everything like that. So they're really going into this segment, and as well, they have lots of partners with autonomous vehicles, including Waymo. The thing I like about Uber is it's globally. Uber is a global term. Uber is in every country. Not every country, but 70 plus countries. And it's the leader there. And what I like about Uber is that they're also partnered with most of the leading AV companies in this country. So they're partnered with BYD, they're partnered with Waymo. So with Uber, it's basically a platform. You can think of it as Amazon for AV vehicles, where companies can partner with Uber, launch their fleet, launch their AV vehicles, and have Uber do the demand aggregating for them. So it makes absolutely no sense that Uber is dropping right now. I don't think Uber is at risk, because at the end of the day, Uber is a platform that is used by 180 million people. The only thing that's being replaced with Uber is drivers, not Uber itself. Uber has a lot of partners. It's deepening its connection in the autonomous space, and I think they're moving in the right space. And I think this is the biggest. I mean, a P of 10 is insane. Look at it. When the internet came, every person said that all these physical stores are going to close because of the internet and things like that. But then you have the well-established stores benefiting from the internet. Now have websites they can do. Now you can order online. All these type of things. I think Uber is also gonna do the same thing. I mean, with AV, they're saying they're gonna kill Uber, but I think actually AV is gonna make Uber stronger. Because in Seattle, the power cut off and Waymo was stuck, and it caused traffic. Vehicles of Waymo were stuck in the middle of the road. People could not move. It's just proved that even though there's autonomous vehicles, you need human drivers still. I'm not saying that Uber is going to be human drivers only. I actually think they're going to be more like more than 50% autonomous and less than 50 human drivers in the future. Also, again, I talked about it, but their Uber Eats segment is growing, and so far as I know, it's really hard for a car to deliver food for you and go upstairs to the elevator and drop it off. And we can also see all this from their revenue growth. They're growing at a 33% CAGR revenue growth, and their revenue did not increase because of autonomous vehicles. So this even makes me more confident. Their gross profit margin and their operating margin is 9% and 39.7% for their gross profit margin. And that's not bad, it's growing. They went from, you can see here that they went from a cash burning machine to a cash printing machine. So that's not bad for them at all. And their return on invested capital is sitting at 26%. So that's not bad at all. I like to see it more than 10, and it is more than 10. So let's see what type of returns can you expect from Uber. As you can see, I mean, it's all over the place, -6% to 104. So these are my calculations. I put a metric growth of 15%, price ratio of 25. I think this is being very conservative for Uber and their future, especially with considering autonomous and all the different streams that they're expanding into. So if I put this at 18, you have an 18% return. I think you can have an 18% to 15% return, or even higher. I mean, 15% is being really conservative, so I'll leave it at 15%. I'll leave it at 15% to be conservative. I really believe Uber is gonna outperform the market next year and the years after as well. And I think it's going to be one of the most underestimated companies alongside with Adobe, to be honest. So this is it for this video. I hope you like this video. Tell me what are your 5 top stocks for next year. Don't forget to like and subscribe, and I'll see you on to the next one.